Hi, I'm Brian Spinelli, Chair of the Investment Committee and Senior Wealth Advisor for Halbert Hargrove. I'm recording this video today to highlight an article I recently published for Kiplinger. Is the 60-40 portfolio truly dead or just hibernating? The purpose of writing this piece was to get investors to focus on the part of their portfolio that is extremely low yielding now and to start considering other options. So I'm going to start out defining what is the 60-40 that we're talking about. It is a traditional playbook used by asset managers to represent a middle of the road portfolio, 60% stocks, 40% bonds. And the purpose of this piece today is to focus on the 40%. We do not think that the 60-40 portfolio is dead. Rather, we do think it's more hibernating while rates and interest are low for the time being. We don't think something like that is dead forever. So what we're going to focus on today is primarily that 40% of the portfolio that will probably provide lower returns into the future for at least the next 1 or 2 years here. So when we talk about the traditional bond part of the portfolio, that 40%, that originally was blended with the larger 60% stock allocation to bring down the portfolio and to bring down the volatility that is represented by high-risk stocks. Some investors in this environment, because they are getting lower returns on that 40% now going forward, are putting more into riskier assets like stocks. We're not saying that's a bad move. We're just presenting cases for alternatives to thinking about it a little differently. So when we think about the traditional bond portfolio today, right around the time I wrote the article, I wanted to focus on how low interest rates really were to paint the picture. So the 2-year Treasury, US Treasury bond was paying roughly 0.13%. The 10-year Treasury, so for 10 years, you get roughly right around 1.1%. It's a little higher today, but still directionally correct. And then there's an index that a lot of us asset managers follow. It's called the Bloomberg Barclays Aggregate Index. And that, if you just bought an index fund that tracked that particular area of the market, yields about 1.2% right now. So as you can see, those are pretty low rates on a very large chunk of a traditional portfolio. You want to take a little bit more risk on that fixed income side, and you want to invest in corporate bonds as a broad category. You're roughly on a broad category going to get about 2%. So still, that's not what traditionally has been experienced on that 40%. And we want people to recognize that it's likely history is not going to repeat itself in the short run on that piece. So what we're asking people to consider, so for all of you investors out there who are thinking about that part of your portfolio and recognizing that interest rates are low, we're not telling you to bail on all your traditional bonds. We're just asking you to consider some things that we are doing as far as portfolio management. So there are things like buffered equity strategies. This is a way to invest in stocks, but to have floors on the portfolio so that, yes, you are shifting risk up a little bit, but you are also putting some protection on the portfolio. Just remember, if you're going to put any protection on any type of investment, that will serve as a little bit of a drag. But remember, you're doing that simply to control risk. You're not trying to capture all the upside of the equity markets. You're recognizing that there might be things you just don't know out there. The other area, which I would say from 2020, probably had a lot of bad publicity just because there was uncertainty around what commercial real estate would do. We do still think there are sectors and areas of the private real estate world that are generating returns and income, particularly multifamily and industrial. I know a lot of commercial real estate got wrapped up in office and retail last year, but there are attractive areas where you can still get higher rates of return than simply investing in bonds. Other areas are private debt, and even looking to the insurance industry or reinsurance industry for premium or insurance yield is another way that we are trying to address blending in some more assets to that traditional 40% of the portfolio. That way we're not just subject to investing and moving assets only into stocks at this point. So I hope this was helpful. I hope the article that we wrote opens your mind to some alternatives that may be available. And we look forward to hearing from you at some point in the future. Thank you very much.